Hello viewers, in the previous lecture we understood the various types of accounts and related rules for journalizing the accounting transactions. We also understood the way these rules are applied and journal entries are passed. In today's lecture, we will have some more examples on journalizing and will look into some additional concepts associated with journalizing. Recall that in our initial example on journalizing, both the related accounts, that is cash account and goods account, were real accounts. Now, let us look into some examples where personal accounts and nominal accounts are also involved. Let us say the firm purchased for credit goods worth rupees 10,000 from A Limited. Now, if we closely analyze this transaction, it is clear that it has a credit aspect, as it is credit purchase of goods by business from A Limited. So, the two accounts involved in this transactions are goods account, that is a real account, and A Limited's account, that is a personal account. Goods account being a real account is governed by the rule debit what comes in and credit what goes out. As the firm is purchasing goods from A Limited, goods are coming in business. So, first part of the rule, that is debit what comes in, is applicable. On the other hand, the second related account, that is A Limited's account, is a personal account, and so it is governed by the rule debit the receiver, credit the giver. As in this transaction, the party A Limited is giver of goods to business, second part of rule, that is credit the giver, is applicable. Hence, in our transaction, goods account will be debited and A Limited's account will be credited, and the journal entry appearing in the books of accounts of the firm will be goods account debit to A Limited's account. Narration would be like being goods purchased for credit from A Limited. Now, let us have one more example relating to personal and nominal account. Let us say the firm paid salary rupees 5,000 to employee Ramesh by check. If we closely analyze this transaction, it is clear that there is a payment of expense called salary by the firm, and this payment has been made by check drawn on firm's bank, not in cash. Here, it is important to note that there is no credit aspect in this transaction, as payment has been made by the firm against the services provided by the employee and no credit or advance is given to him. So, personal account of employee Ramesh is not related for this particular transaction. So, the two accounts involved in this transaction are an expense called salary, a nominal account, and account of bank where the check will be presented for payment, a personal account. As a bank is an artificial person, salary account being a nominal account is governed by the rule debit all expenses and losses and credit all incomes and gains. As payment of salary is a payment of an expense of the firm, so first part of the rule, that is debit all expenses and losses, is applicable. On the other hand, the second related account, that is bank account, is a personal account and so is governed by the rule debit the receiver, credit the giver. As in this transaction, the bank will be making payment, so it will be a giver. So, second part of the rule credit the giver is applicable. Hence, in our transaction, salary account will be debited and bank account will be credited, and the journal entry appearing in the books of accounts of the firm will be salary account debit to bank account. The narration will be being salary paid to Ramesh by check. Let us discuss some more concepts related to journalizing of accounting transactions. First, let us talk about classification of goods account. You might have noted that in our first and second examples relating to sell and purchase of goods, in both the journal entries, goods account has been recorded, that is either debited or credited. Apart from sell and purchase, goods account may have many other transactions which goods are returned back which are purchased by the firm earlier, what you call purchase return. Customers return the goods back to the business, what you call sales return. During a particular accounting period, there can be many transactions relating to all these aspects of goods account. In such a situation, it is very difficult for the firm to look into these aspects of goods account individually. So, for the sake of convenience in recording the various aspects of goods account, it has been classified in 6 different accounts, that is opening stock account, purchase account, purchase return account, sales account, sales return account and closing stock account. You know that goods account is a real account. As all these accounts are classification of goods account, all these accounts are also real accounts. The first and last accounts, that is opening stock account and closing stock account, show the value of goods at the beginning of the accounting period and at the end of the accounting period respectively. The remaining 4 accounts are operational and can be understood by their nomenclature respectively. Purchase account is meant for recording the purchase of goods or merchandise by the firm, and sales account is meant for recording the sale of goods or merchandise by the firm. Likewise, purchase return records the return of goods or merchandise earlier purchased by the firm back to the suppliers, and sales return account records the return of goods or merchandise back from customers that was earlier sold by the firm. As in case of purchase of goods by the firm and sales return by the customers, goods come in business, these accounts, that is purchase account and sales return account, have basic debit nature. Remember, rule governing the account is debit what comes in. On the other hand, as in case of sale of goods by the firm and purchase return to suppliers, goods move out of business. So, these accounts, that is sales account and purchase return account, have basic credit nature. Again, recall that it says credit what goes out. Now, let me share something important with you. You know that selling of goods, purchasing of goods and returning of goods sold or purchased earlier are regular or ordinary transactions of the business, which account will be relevant if goods are moving out of business for some extraordinary reasons. For example, assume a firm distributes goods as free samples. Now, this is a common practice. Firms distribute goods as free samples. As all the 4 subcategories of the account that we discussed, that is goods, barring the opening stock and the closing stock, goods, that is purchase, sell, purchase return and sales return, are for specific categories of transactions. You must have an obvious doubt in your mind that which account is relevant for recording movement of goods out of business as free samples. It is important to note here that transactions relating to goods of the business, but not falling in 4 specific categories of sell, purchase, sales return and purchase return, are recorded through purchase account only. Let me simplify it. If a transaction is affecting goods account, but neither there is sell nor purchase nor sales return and nor purchase return, it is recorded through purchase account. Hence, purchase account, which is normally debited, is credited in all such transactions. Now, let us talk about the owner's account. Owner's account can also be classified. Recall that in one of our earlier lectures, we understood about separate entity concept, which states that business is different from owner and books of accounts are accounts of business firm and not of the owner. So, like other persons, the owner or the businessman is also to be recorded in books of accounts as a different entity. The businessman gives money or other things to business at the time of starting business and later on as and when the need arises. Similarly, the businessman withdraws from business in cash or kind as per his requirements. Based on this relationship, the account of the owner or businessman is divided in two subcategories, that is capital account and drawings account. Capital account is about the capital, that is the capital contribution is made by businessman in business out of his personal sources. Whenever a person starts a business, he invests some money from his own sources. Similarly, at later stage also businessman keeps on contributing to business in cash or kind. All these represent the stake of owner in the business and is known as capital. So, capital account represents the giving aspect of the owner and basically has credit nature. You remember that rule governing the personal accounts is credit the giver. Drawings account on the other hand refers to when the owner withdraws from business for his personal purpose, be it in cash or in kind. Here, it is important to understand that even if a businessman withdraws a part of profit earned by business, it will amount to drawings. So, drawings account represent the receiving aspect of the owner and basically has debit nature. Remember that personal account says debit the receiver. Let us discuss the concept of discount and its treatment in books of account. First, let us understand the classification of discount and then we will talk about its treatment in books of account. Discount is the amount of benefit offered to a customer. Seen from a business point of view, it may be loss or gain. When goods are sold by the firm and discount is allowed by business to its customer, it is a loss for business as it loses some part of the sales revenue. On the other hand, when a business purchases goods from its suppliers and receives discount, it is a gain to it. But before we understand the accounting treatment, it is important to understand that the discount, whether received or given, can be classified in two categories on the basis of its nature. Discount can broadly be classified as either trade discount or cash discount. First, let us understand trade discount. Trade discount, when discount is allowed by seller to the purchaser on the list or catalog price of the goods, it is termed as trade discount. In fact, trade discount is a dummy discount and the basic objective behind offering trade discount is to promote sale. Such discount is allowed to all the customers at the time of selling goods, irrespective of the fact that whether the goods are sold for cash or for credit, or the customer is a known or a new one. The list or the catalog price and the amount of trade discount are not recorded in books of accounts. The price arrived at after deducting the trade discount is the actual transaction value and is actual sell price or maybe purchase price. The transactions are recorded in books of accounts on the basis of net price, that is price that is arrived after deducting the amount of trade discount. Now, let us understand cash discount. This discount on the other hand is discount allowed by seller to the purchaser for making immediate payment of price or on the payment within a specified time period. It implies that cash discount is not offered to all customers, but it is offered only to those customers making payment in specified time period. The basic objective behind offering cash discount is to motivate customers for prompt payment of price. Such a discount is an actual loss to seller firm and gain for buyer and hence is recorded in books of accounts. It is offered on the actual transaction value and the price after deducting the cash discount is cash price of the transaction. One important thing that you should note here is that cash discount is always recorded in books of accounts at the time when price is actually received or paid. This concept of price and discount can be understood as, first is there is a list price that is mentioned in the catalog. Then from this list price of the commodity, trade discount is offered. After deducting trade discount, the price that arrives is the actual price of the commodity, or what you call net value or transaction value. From this transaction value, cash discount if offered is deducted, and after deduction of cash discount, the leftover price is cash price of the commodity. Now, based on your understanding, you can identify the major differences between trade discount and cash discount. For example, trade discount is allowed at the time of sale, whereas cash discount is allowed at the time of receiving payment. That is also if payment is received within a specified time period. Secondly, trade discount is allowed to all the customers, whereas cash discount is allowed only to customers making payment within specified time. Then trade discount is calculated on catalog or list price of the goods, whereas cash discount is calculated on actual or net price of the goods. Moving further, trade discount is offered with the objective of increasing sales, whereas cash discount is offered for fastening the collection of sale price. Trade discount is, as I told you, is a dummy discount. So, there is no actual loss or gain involved, hence it is not recorded in books of accounts, whereas cash discount is actual loss or gain, and hence it is recorded in the books of accounts. To understand these concepts relating to trade and cash discounts, let us have a look into some examples. Let us say the firm purchased goods worth rupees 15,000 from Ram on the condition of 10% trade discount. As we discussed, trade discount is a dummy discount and hence it is not to be recorded. So, the transaction is a simple credit purchase transaction. What is important to note is the transaction value is 13,500 rupees, that is 15,000 minus 10% of trade discount, and not the 15,000 rupees which is list price. Now, recall that transactions are to be recorded on the basis of actual transaction value and not on the basis of list or catalog price. The journal entry for the same will be purchase account debit to Ram's account for 13,500 rupees. The narration goes like, being goods worth rupees 15,000 purchased for credit from Ram at 10% trade discount. Note that in the transaction we have debited purchase account, not the goods account. Further, note that it is not clearly mentioned that whether the transaction is for cash or credit. It implies that in such a situation where name of party is informed and there is no cash discount, presence of name of party signifies the transaction to be a credit transaction. Let us have another example. Let us say the firm purchased goods worth rupees 50,000 from Gopal on the condition of 10% cash discount. It is not clearly mentioned that whether the transaction is for cash or credit. In such a situation, presence of cash discount, whether the name of party is there or not, signifies that the transaction is a cash transaction. Further, as there is no trade discount in the transaction, rupees 50,000 is actual transaction value itself, means there is no list price or catalog price in this transaction, and we have to record this transaction for 50,000 rupees. The price after cash discount is 45,000, that is 50,000 rupees the actual value of transaction minus 10% of cash discount, that amounts to 5,000. So, 50,000 minus 5,000, 45,000 rupees is the cash price of the transaction. The journal entry for the same will be purchase account debit to cash account to discount received account. Now, see that purchase account is debited for 50,000 rupees, the full value of the transaction. 45,000 rupees is credited to cash account. As I told you, this is the amount of cash that is actually being paid by the firm for payment of goods, and 5,000 rupees is discount received by the firm. So, discount received being an income is credited to discount received account. Note that as the transaction is a cash transaction, the personal account of the seller, that is Gopal, who is selling to the business firm, is not relevant in this transaction. Now, let us have one more example on this. Let us say the firm purchased on credit goods worth rupees 50,000 from Gopal on the condition of 10% cash discount. We have understood that cash discount is recorded at the time of making or receiving payment, as it is clearly informed in the transaction that the purchase is for credit. No cash discount is to be recorded as of now, and it is a simple credit purchase of rupees 50,000. The journal entry for the same will be purchase account debited 50,000 rupees to Gopal's account 50,000 rupees. So, we have recorded for the credit purchase of goods worth rupees 50,000. Note in this entry that there is no trade discount in the transaction. It implies that cash discount can be offered directly without offering trade discount. In such a situation, the price informed in the transaction is actual transaction price or net price. Further, the transaction is clearly informed to be a credit transaction. So, presence of name of party or cash discount will not make any difference. Now, further assume that the business made the payment to Gopal within stipulated time so as to avail the cash discount. In that case, the journal entry will be Gopal's account is debited for the full value of the transaction, that is 50,000 rupees, because we are settling his account. We are paying cash of 45,000 rupees. So, cash is moving out. So, we are crediting cash account for 45,000 rupees, and as we are receiving discount of 5,000 rupees. So, there is a discount, that is discount received credited in the transaction for 5,000 rupees. Note that there is no purchase account in the transaction, as purchase was done in the previous transaction, and as of now we are making payment. Further, note that as it is informed that payment is made within the stipulated time, cash discount has been availed. Had it been informed that payment was made after the specified time period, no cash discount would be received and full payment of 50,000 rupees would have been made by the firm. In absence of such information, you have to assume whether or not payment is made within specified time, and cash discount is to be treated accordingly. Let us have more example on this. Let us say the firm purchased from A Limited goods worth rupees 20,000 on the condition of 10% trade discount and 5% cash discount. Now, you might have understood that as there is a cash discount, the transaction is implied to be a cash transaction in spite of the name of the party. So, both cash discount and trade discount are considerable at this point of time. It means the list price of the transaction is rupees 20,000, the net price after deducting of trade discount is 18,000 rupees, that is 20,000 minus 10% of trade discount, and the cash price of the transaction is 17,100 rupees, that is 18,000, the actual transaction value minus 5% of the cash discount. As it is a cash transaction, personal account of the seller of the goods, that is A Limited, will not come in picture. We have also understood that trade discount is not recorded in books of accounts, whereas cash discount is to be recorded. So, in all there are 3 accounts connected with this transaction. First is purchase account, you are purchasing goods. Second is cash account, you are making payment in cash. And third, because you are earning some cash discount, so discount account is also there. Discount received by you is representing the cash discount. So, all these 3 are related with this transaction. and the related journal entry will be purchase account is debited for the transaction value, that is 18,000 rupees that you arrived at after deducting the trade discount. Then cash account is credited for 17,100, the actual amount of cash that you paid, you means the firm paid, and you have earned a discount of 900 rupees. So, it is credited to discount received account. You might have noted that all the examples that we have discussed are related to purchase of goods. I have intentionally done that so that you are clear with one aspect, that is purchase. In case of transactions relating to sale of goods, sales account will come in place of purchase account, and similarly whenever there are transactions relating to purchase returns or transactions relating to sales return, the respective accounts, that is purchase return account and sales return account, will come in picture. You shall practice all such transactions from books on financial accounting, that is very important. Now, let us take some transactions and see what accounts are to be debited and credited and why. Let us say the owner Mr. A started a business by investing cash rupees 3 lakh, machinery of rupees 2 lakh and furniture of rupees 1 lakh. Now, in this case you can observe that cash account, machinery account and furniture account, these accounts are to be debited. All these are real accounts, they are representing properties coming in business, cash is coming in business, machinery is coming in business and furniture is also coming in business. So, all these 3 accounts are to be debited for respective values of 3 lakh rupees, 2 lakh rupees and 1 lakh rupees. Whereas, this 6 lakh rupees represent contribution of owner, that is capital of rupees 6 lakh in business. So, capital account is credited because owner is giver of cash, machinery and furniture, all totaling to 6 lakh rupees. Let us say the firm opened current account with State Bank of India by depositing rupees 50,000. Now, there is bank account because you are opening a bank account. So, there will be a bank account, you can call it State Bank of India current account, you can call it simply bank account, and when you are opening account with the bank, bank is receiver of money. So, governed by the personal account, debit the receiver, bank will be debited, and cash is moving from your business, cash is a real account, cash is moving out of business. So, credit what goes out, cash account will be credited. Another example on this is, let us say purchased office premises for rupees 5 lakh from Gagan Construction, for which payment was made through check. Now, because you are purchasing office premises, you can call it office premise account or building account, and at the time of purchasing the property is coming in business. So, going by real account, debit what comes in, building account will be debited for rupees 5 lakh. Because you are making payment through check, so bank account will come in picture. Bank will be given in this case because your check will be presented to bank and bank has to pay money from your account. So, bank is a giver of money. So, bank will be credited. In the next example, let us say we purchase goods for cash of rupees 40,000 from Ganpat Rai and Sons on 5% of trade discount. Now, remember that the transaction value is not 40,000 because there is 5% of trade discount. So, 40,000 minus 5%, it will make 38,000 rupees. Because we are purchasing goods, goods are coming in business. So, we have to debit goods account for 38,000 rupees and we are making payment in cash. So, cash account, cash is again a real account, it is moving out of business. So, it will be credited. Let us have an example on payment of expense called wages, paid wages of rupees 2,000. Now, as I said, wages is your expense, expenses are to be debited as per nominal account rulings. So, we are going to debit wages account in this transaction. You are paying wages in cash. So, second account is cash in this case, cash is moving from business because you are making payment. So, credit what goes out, cash account will be credited. Let us have another example, goods of rupees 1,000 are purchased from Mohan Brothers and now are returned back. So, you are returning back the goods. So, it is a purchase return transaction. So, one account will be purchase return for sure. Second account, because you are returning this goods to Mohan Brothers. So, it is a credit transaction. So, Mohan Brother will come in picture. Returning goods to Mohan Brothers is receiver of goods. So, as per the personal account ruling, Mohan Brothers will be debited. And when you are returning goods from your business, goods are moving out. So, purchase return indicates movement of goods out of business. So, credit what goes out, it will be credited. Let us have another example on sales. Now, we are selling goods to Amritlal and Sons for 30,000 rupees. Now, I hope you understand that because Amritlal and Sons name is there and you are not informed that it is a cash transaction, it has to be a credit transaction. Based on this, Amritlal and Sons are receiver of goods because you are selling goods to them. So, they are receiver. So, they are to be debited. Goods are moving out of business. So, credit what goes out, sales account has been credited for 30,000 rupees. Connecting to our Amritlal and Sons transaction, let us have one more transaction assuming a sales return. Let us say Amritlal and Sons returned back goods worth rupees 5,000. We sold them goods worth rupees 30,000. Now, they are returning back goods worth rupees 5,000. So, sales return indicates goods coming back in business. So, sales return is debited, a real account, and Amritlal and Sons personal account, they are giving goods back to us. So, they are in the shoes of giver as of now. So, Amritlal and Sons is credited as credit the giver. Let us take some extraordinary transactions. For example, we are distributing, we means the firm is distributing goods worth rupees 3,000 as free samples. Now, when you are distributing goods as free samples, it is basically your advertisement expenses, right. So, advertisement is an expense. So, we are debiting this account for 3,000 rupees, the value of goods distributed. And now, remember I told you that whenever goods are moving out of business for extraordinary reasons, it is always treated through purchase account. So, the goods account which is normally debited is credited here because it is recording movement of goods out of business as free samples. So, we are crediting purchase account. By now, you might have understood the way accounts connected with various transactions are identified, the rules of journalizing are applied and journal entries are passed. You need to practice it considerably to have an expertise on it, and you should, because journalizing is the basic of entire accounting process. In the coming lectures, we will have deeper insight into journal by learning about its classification, that is subsidiary books. Till then, bye bye. Thank you.